the big thing that's affecting apartment owners, multifamily owners, commercial real estate owners in general is the expenses that are over inflation rates. So when I look at our expenses, there's four big expenses, three really big ones: labor, construction materials, insurance, and property taxes. And labor, insurance, property taxes being the three big ones. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer, and excited to have you here. If you haven't subscribed to the show, I'd love you to subscribe. If you are a frequent listener, I would love for you to be able to share this show out. And I want to reach more people. So love to share this show. Love to have you share the show. I really appreciate it. And also go onto our Facebook group. Let us know, or just connect with me directly, LinkedIn or Facebook, and let me know what kind of topics you want me to cover. What's important to you? What do you want to see? Who do you want to hear from? I'd love to hear that too. I'm trying to bring on a more, diverse group of people. I want to try to bring more and more value to you as listeners. So please let me know what you're looking for. That would be awesome. All right. So what I want to talk about is what our outlook for multifamily is. So Endurus Capital's outlook for multifamily in 2025, and really 2025 and maybe a little bit beyond. And I've talked about this a bit in the past, but I wanted to dive into some of the things in the weeds. And so first off, what I want to talk about is market cycles, and we are in the midst of a changing market cycle. So we saw our market, bottom out back in, call it 2000. Well, let me start over. We saw a peak around 2006, 2005, 2006, and then it started to go down, and we saw it bottom out, call it 2011 to 2013 was pretty much the bottom. And then it started going back up, and it climbed from, 2013 all the way until 2022. And so, but what we saw from 2013, 2014, 15, and 16 was some pretty slow growth. Definitely achieved some good movement, but slow growth. And then starting in 2016, 2017, we started to see that growth pick up even more. 2017, 2018, 2019 were definitely good years of growth. And then we saw the pandemic, and everybody knows what happened there. The world was really scared and everything shut down, and we didn't know what was going to happen. Now you could call that a dip, and it was a very slight, very temporary dip. But what happened there is that added rocket fuel onto the commercial real estate market, and really the equities market in general. And we saw prices skyrocket. We saw rents go up, 20, 30% per year for like a 2-year period of time there. We saw prices just drastically increase. It was kind of unreal. Even in the slow, steady Midwest, we were seeing prices that were going up higher than really ever before, right? We're seeing these rents grow by 9, 10%, or even higher. Of course, in some of the other markets, the Austin, Texas, the Phoenix, the Dallas, those markets, those rents were going up by 20 to 30%. It was just crazy. And prices were doing the same, but at the same time, interest rates were rock bottom. Right? We locked in a loan at 2.7%. We just assumed a loan from another person that locked in his loan during that time, and we assumed that loan at 2.62%. So interest rates were rock bottom, prices were sky high, inflation, real inflation on, labor and all that kind of stuff, materials, and it just wasn't going up meaningfully. Well, that shifted quickly. And in 2022, about halfway through the year, we started to see inflation really skyrocket. Actually, beginning of the year, inflation started to really really ramp up, but it really affected us. And we knew, they started calling it transitory. Oh, this is transitory. It's not going to stick around. Well, guess what? It did. And we peaked at about I think it was 9.1, 9.3%, somewhere around there. And that was in 2022. And we saw then inflation stay high, propped up through all of 2022 into 2023, slowly dropping in 2023. But it still was high, right? It still wasn't low in 2023. Finally, in 2024, we saw inflation that was in the threes, it was in the high twos. We're starting to get to a point where you can go, okay, it's not nearly as bad. But those are kind of the things that happened. Interest rates then went from basically the Fed funds rate of 0 to interest rates, the Fed fund rate of 5.25 or so, 5.25 to 5.5. That was a huge change. Unpredictable, honestly. You can say, well, in hindsight, really easy to predict, but it wasn't. Nobody has a crystal ball, right? All the experts were saying maybe go up 300 basis points. Like that you were like crazy if you said that. But it went up over 500 basis points, and interest rates went from being, like I said, like 2.7%, 2.6%, 3% to now in the low sixes. So that's changed the ball game. Prices are down 20 to 25% kind of nationwide. Rents are down in a lot of markets, and things have changed. So we're in this new market cycle. 2022 was our peak. That was peak pricing, certainly. And now 2024, we're in this down cycle. Now, how long will it last? Sorry, 2025. We're in 2025. 2025, we're in this down cycle. Now, how long it'll last? That's the interesting question. Real estate, some people think that real estate, like they forget, real estate's a slow moving asset class. This isn't the stock market. It doesn't go up and down in a day, right? It moves slow. So a lot of people forget. Again, reminder, the last time we saw this, and actually the time before, what we saw is let's talk about the last time, 2006, 2005, 2006, right? That was the peak. Then it went down in value pretty rapidly through about 2008, and then it slowly continued to go down in value through about at least 2011, 2012. Depends on your market and all that kind of stuff. So it went down in value from 2000, let's call it 6, through 2012. So 6 years of down cycle before it started coming out of the dumpster, and it didn't come out quickly either, right? It didn't really start to come quickly until about 5 years after it started going up. And then we started to see a pretty quick rise in prices. 4 years. Will that happen again? And my answer will be yes. Now, that was a big recession, right? The Great Recession. Is this one as bad? I don't know. We'll find out, right? But in commercial real estate, we're definitely in a recession, right? We're seeing prices that are down. How long will it take before they start going back up in a meaningful way? I think we've got some time. So anyways, all right, let's talk about Endurus's multifamily outlook. So our expectation is that transaction volume, we're going to see a lot more deals hitting the market as sellers are finally saying, you know what, we're going to sell. Like we either have to sell, loan maturity, whatever it might be, we have to sell, we're going to lick our wounds. You also have a lot of sellers that are like, hey, you know what, I'm going to sell this deal. I bought it. It's done really well. We've cash flowed. We maybe bought it 10, 15 years ago even, but we're going to sell this deal because we think there's going to be great opportunities coming. Our loan is coming due here in 2025 or 2026, and we're going to sell this. And so those are going to be people that are going to sell still for profit, but they're ready to sell. And then you're going to have the people that are retiring. Got to remember this. A lot of the apartments in the US are owned still by mom and pop owners. They maybe own 1 to 5 apartment buildings, and they are the baby boomers. That's a huge percentage of the people that own these properties are baby boomers. They've maybe owned them for a long time or traded into them from one to the next to the next, right? And so they own these properties and they're willing to sell right now because they're ready to retire. And they don't want to keep on hassling with this. By the way, that's a great potential for seller financing. It's a great potential for a 721 exchange where they keep their money into the deal. It's a great potential opportunity for them to be one of your passive investors in one way or the other. So keep that in mind as you're buying properties from people. It's good to get good relationships with them. So they're potentially one of your investors. Of course, understand who they are. If they're, doing a ton of deals and that's what they probably aren't going to be one of your investors, but maybe it's still good to have good relationships with all the sellers you're dealing with. So yeah, anyways, we think there's going to be a heightened amount of properties that are hitting the market. It'll be interesting to see what those properties look like and how those prices align with the market, with the expectations of the market. For us, we have to have cash flowing properties. We have to have properties that cash flow, or be a huge value add story. So we're buying a property right now that's got a big value add story, exciting opportunity. It's not got, it doesn't have, it will have some cash flow, but it doesn't have some, great cash flow like we'd typically love to see. But this just has so much meat in the bone. We are buying it for an amazing basis play. And that's another thing. Like, you got to look at the basis you're buying these properties at. This one, we're buying it at such a good basis. It makes sense every day of the week. So we'll see what happens with the buy sell gap. Does that continue to improve? What are we going to do? Again, for us, cash flows first, and then we look at equity. We want, of course, be able to create some sort of value, but for us, cash flow matters big time. Here's the deal: as you are in a bottoming market cycle, in a market cycle that could stay low for an extended period of time, I truly think our market right now has the potential to stay where it's at or similar as far as cap rates go and kind of sales, just the excitement in the market. I think it could stay where it's at in 2024. I think it could stay there certainly through 2025, where we're at right now, but I think it's going to stay there in 2026, potentially 2027. It's hard to say. It's a long ways away, but potentially even 2028. So we are looking at this as what does it look like to hold these properties for a longer period of time? We have to cash flow. That's so important. We can't be looking at these properties and saying, oh, we're going to sell for huge profits in the end. Now, again, if we got a huge value add, if it makes a lot of sense, this current deal that I'm talking about, we're still selling it at today's cap rate. So that could make a lot of sense. All right. You will see, and we already are seeing different dynamics in different markets. And that's really important. I'm going to talk a lot of nationwide, but we got to make sure we're separating markets. So when we're talking different markets, we've got the Midwest and Northeast. Those are kind of acting similar to each other. They're definitely different markets, but they're acting similar to each other, where we've got slow, steady rent growth. We've got 2 to 4% rent growth in those markets. Vacancy rates are still fairly low. You've got 95% plus occupancy in most of the markets. So nice rent growth, nice occupancy. You don't have a ton of building. Values have gone down just purely because of interest rates and overall just the perception in the market. But everything is going well in the Midwest. We're also seeing a lot of industry move into the Midwest that you didn't traditionally see. So we're seeing a lot of these tech companies. We're seeing a lot of, um, like Columbus, Ohio, chip manufacturing. So tech manufacturing. We're also seeing a lot of distribution hubs. We're seeing data centers. So the Midwest has a lot of energy. We're seeing anything with energy in the Midwest. So we're seeing a lot of industry that we necessarily didn't see before moving to the Midwest because of affordability, because of the workforce there. And so I think the Midwest has continued to be a good, strong story for the next decade plus, and I think for a long time. Um, we are seeing the Southeast, the South, and kind of the Southwest and um, West Coast. Those areas are a lot different. They are seeing rents decline. They are literally bringing down the market nationwide. So they're seeing the rents decline. They are seeing occupancy fade away. They're having problems right now. So we are bullish on the Midwest. That's where we're looking. That's kind of where we always look. We love that the Midwest is doing well. So, what is drive? Mentioned 20 to 25% price declines already from the peak in 2022. So, what is driving those rent declines? Um, we have kind of four things, and they've all hit at the same time. So, first and foremost, I already mentioned this: interest rates. Interest rates have risen just dramatically, right? Uh, in call it 2010 all the way through about 2022, early part of 2022, interest rates were below 5%. In fact, again, a lot of times, a lot of that time it was below 4%. And then some of that time it was even below 3%. By 2023, inflation was rampant and we saw interest rates just really start to skyrocket. And so now again, we're in that 6+% range. So it's a big, meaningful change that really affects the cash flows. It really affects the overall value. Interest rates don't appear to be going down anytime soon. I know a lot of people are always continue to speculate that interest rates are going down. I don't know what. I don't know why they would. It doesn't feel to me like interest rates are going to be going down over the next 12 months. But then again, I didn't see interest rates going up where they went, and no economist did. So we'll see what happens with it. But I just, my crystal ball says that interest rates will kind of stay where they're at, hover around that 5 to maybe 6%. Maybe they go a little bit higher, maybe they go a tad lower, but I think right around that 5 to 6%, we're going to see them hover. The next one is inflation growth. In this one, what's crazy is when you couple inflation growth with the rent growth, there's a big disparity here. So I'll talk about inflation growth first. So inflation skyrocketed. As I mentioned, 9%, 9.1% peak level in 2022, and then it's continued. It's continued to go, and when you just continue to add on to high inflation year over year, then we really start to see prices go up. And so in 2025, as we sit, we're sitting right around 2.8% inflation. But again, that's on the heels of 9.1% inflation in 2023. I think we hovered right around that 4% average inflation. So um, the big thing that's affecting apartment owners, multifamily owners, commercial real estate owners in general is the expenses that are over inflation rates. So when I look at our expenses, there's four big expenses, three really big ones: labor, construction materials, insurance, and property taxes. And labor, insurance, property taxes being the three big ones. But we've seen labor skyrocket. In my assisted living business, for instance, we were paying a typical person coming in. We were paying them like $11 to $12 per hour with if they didn't have a lot of experience. And now we have to pay that same person $15 to $17 an hour, depending on the market, maybe even more. 15 is the low end. So it's more like 17. That's a big jump in labor. We're seeing the same thing in our maintenance tax. We're seeing the same thing in our leasing agents. So we're seeing that we have to actually pay people a lot more, where you could pay a nice salary was 45 to $55,000 a year for, somebody who's at the property all day, office manager. And I mean, now you're talking like 20% or greater over that. So we saw a big labor increase. Materials, of course, we saw what happened with materials. Those went up. Insurance is the biggest one. We've seen insurance. We had a 66% increase on one of our properties in our insurance costs. That is massive. So we've seen big insurance jumps kind of across the board. And so I've talked with other owners that have seen well over 100% insurance increase in just a 12-month period of time. So over the last 24 months, I mean, insurance costs have just skyrocketed. Property taxes, same thing. They're going up. The government seems to need more and more money, and of course to cover all their costs. And so we've seen property taxes skyrocket over the last couple of years. I've seen some of my properties double over just a couple of year period of time. So couple inflation with the rents, and why the Midwest is okay and doing better is because the Midwest has seen this higher inflation. So that's certainly hurt. But now we're seeing more stabilized inflation, and we're seeing rents right now that are keeping up with, or potentially even a little bit higher than inflation. So the Midwest is doing well in that regard. But nationwide, on average, rents are declining. The U.S. as a whole is still seeing rent declines. It's been like that for the past 2 years, and year over year rents declined by 1/2 a percentage point. So 1/2 percentage point. Now, that's not huge, but that's still a negative. And when you couple that with 2.8% year over year inflation, now we've got, you're eroding your rents to inflation pretty significantly. The good news, it seems like it's kind of starting to turn the corner. 2025 is going to see a lot of deliveries early on, but we're not going to see as much. So that's the next one, is rents are declining, but we're seeing inventory go up massively as well. Back to rents. I thought this was really interesting. We've seen a median rent drop of 5% over the last couple of years, since the peak of 2022. $72 on average per month. It's below its 2022 peak is what rent is. So, but here's the other kicker. We're still roughly 20% above prices seen in January of 2021. So if you look at it as how have we increased over the years, we're sitting here in January, actually for February of 2025. So for 4 years, we've gone up 20%. We're still seeing that's still pretty good rent growth overall. It just happened all at once and then just stopped, right? All right, let's go to the supply. So record supply has really hit the market the last several years. We keep on getting record supply every year. And it's like, when is it going to stop? Well, finally, it's going to stop. So record supply hit the market. It's especially prominent in the Sun Belt, southern states. Think of the Smile states. The nationwide vacancy is at its highest level in over a decade, hitting 6.9%. A lot of markets are well over 10%. So the markets in the Sun Belt, think of Austin, Texas. Austin, Texas is just getting clobbered right now. There's so much building happening in Austin and San Antonio. I was in those two markets this summer, and it was crazy how much building is happening there. They actually have had a 30.7% increase in new apartment units over the past 5 years. So rents in Austin are declining by 9.3%. Now, some other markets are seeing a massive amount of inventory increase. Denver is not a smile state. That has seen a massive amount of new apartments. I think it's right around that 29% over the last 5 years. Nashville, Tennessee is seeing right around 28%. Charlotte, North Carolina, seeing 27%. Those markets are all seeing rents decline and will likely continue to see markets decline over the next, you know, for sure all of 2025, likely most if not all of 2026. Those markets are going to see those rent declines. Markets like Austin, Phoenix, Denver, Salt Lake City, Nashville, Raleigh, Charlotte, Jacksonville, Atlanta, you name it. A lot of those southern markets. We're actually seeing Florida take a pretty good rebound already. So I think Florida is going to be out of the woods probably towards the end of 2025, where they're going to start to see some good rent increases. People are still moving into those markets, although they're moving into these other markets that I mentioned too. It's just there's too much inventory and they just can't handle it. So 2025, the first 2 quarters, we're going to continue to see a ton of deliveries happen. And then by the middle of 2025, we're going to see that to start to drop off very quickly. By the end of 2025, a lot less inventory. And 2026 is going to be a year where the markets can kind of finally just breathe a little bit and they can start to catch up. And hopefully, the Sunbelt markets, these markets that have overbuilt, can continue to see the population coming in and can get just a little bit of a break from builders. They don't build quite so much over the next few years. So we'll see what happens there. But I feel pretty confident in all those markets that I mentioned, plus many more in the Sun Belt, that they will bounce back. It's going to take, I think a lot of them, it's going to take all of 2025 and potentially all of 2026 before they start to see that rebound. But these are very strong markets and they likely will see a pretty nice, healthy rebound. It just might take a couple of years. So if you're in those markets, be patient. Watch what you're buying in those markets. Don't count on rent growth. Don't underwrite for rent growth for at least minimum of a year. But I would even caution you to not have much, if any, rent growth for the next 2 years in those markets and have nice reserves, right? Also be able to withstand some higher vacancy rates. Most of those markets are 10, 11, 12% vacancy rates. So just count on that and understand what's going on in your market. And you'll be fine. All right. So the other thing I want to hit on is commercial lending. Commercial lending is picking up steam. We're seeing a lot more lending. It's interesting lessons. So we learned, we've done we purchased 2 properties in 2024. We're purchasing a property in 2025. And I'll talk about, so these properties, we assumed one loan and we had new financing, agency debt finance. So the assumed loan was agency debt and the new loan was agency debt. And then this current loan is with a local bank. So 3 different experiences. But what we've noticed is underwriting is a lot tighter. Scrutinizing the buyers is a lot tighter. Look, we've got a lot of these loans before. I'm sending documents that I've never had to send before. I'm detailing things that I've never had to detail before. I'm getting asked questions on documents I've sent in previously for previous deals. And they're going, well, explain this. Give me more detail on this. Give me more detail on that. I want to know more. And so the scrutiny is definitely higher. That's what the agencies, and it's taking longer to get these deals done. So with the local bank, we had a decent amount of appetite. It's feeling like the local banks are starting to free up a little bit. Now they are still a little bit more cautious. Interest rates are definitely higher, but the local banks, they got competitive. We had them, kind of bidding against each other a little bit. And so we got, some pretty good results with the local banks. They're freeing up, I would say, maybe still pretty tight, but a lot more open. And the market, as I look and do research in the market, is proving the case, right? So when I look at the market, commercial, multifamily, commercial loans, the loan originations grew by 500 million in Q3 up from Q2, right? Multifamily loans grew 54% year over year. Still 53% below pre-pandemic levels. So pre-2022, call it. But nice, healthy growth, right? It's going in the right trajectory. So, and we'll see, as if the market continues to be more stable, where interest rates don't go up and down like crazy, I think we'll see more and more lending happening in 2025 and 2026. So we'll see what happens there. If interest rates go down, that'll really help push what's happening in the market. The stats for the banks are leading the way on non-agency loans for multifamily. So there's two things that are pushing that: more deposits and a lot of loans maturing. And so these banks are freeing up cash. Banks have an appetite to lend in today's market. They want to get into the market today. They're definitely more cautious, but there's banks that are ready to lend. So banks captured 43% of the market share, that's non-agency market share, compared to just 18% market share in Q3. So that was Q4 of 2024. Life insurance companies, their market share is about 33%. Then alternate like bridge lenders, they had 23%. So we're seeing a lot more local banks get in the game versus some of the other players. And I've already talked about interest rates, but right now we're seeing the treasuries have a lot more stabilization. We had treasuries, up above 5%, and then go into the threes, the upper threes, and now we're hovering right around that 4.5%. So we'll see what happens. But again, I'm a big proponent right now of fixed rate debt. I think bridge loan is just not that great. I think if you have a floating rate debt, I don't care if you get a rate cap or not. I mean, I certainly care. I think that's the best thing to do, but I think fixed rate is the way to go. I have a study that I just put out there too and put it out on LinkedIn. When I look at a case study of a 5-year fixed rate debt versus a bridge loan, it's way cheaper to get a 5-year fixed rate debt. In fact, it's going to be at least half the cost, probably more like a third of the cost, potentially even way less than that. So fixed rate debt is the way to go. If you have a property that's 90% occupancy and can qualify, or can get a local bank loan, it is definitely a much better deal to get fixed rate than a floating rate bridge loan that's going to just cost you a lot more money and have a ton more risk. Okay, the last thing I want to talk about is we got this new HUD secretary. So Scott Turner's our new HUD secretary. There's a big push to move the agency, Fannie Mae and Freddie Mac, to be privatized. So his goal and Trump's goal is to get those privatized. So that's, they back $7.5 trillion in home loans. They want to get those two agencies out of government control. So that could reshape kind of how we look at finance and what happens there. And I'm not exactly sure what that'll mean, but it'll be something to keep an eye on as this goes. So beyond that, he is trying to cut back, right? There's the Doge, and trying to really clean up government inefficiencies. And so that's another thing he's trying to do is really clean up, HUD's $60 billion budget, trying to clean that up, try to shrink government oversight. So we'll see what happens. He's also pushing to get states to ease their zoning laws to try to bring down housing costs and increase supply. So that'll be interesting to see what happens if, the federal government technically doesn't have, any authority over that type of stuff. But if they incentivize, if they try to push local governments into doing this, that could potentially free up and allow for some more building. That definitely is going to impact, multifamily and how that looks over the next, decade plus. All right. So what does this all mean for for us at Endurus, this means we're excited for 2025. I think it'll start out a little slower. That's okay. It'll continue to ramp up. And by the end of the year, I think there's going to be some nice buying opportunities. And it might happen earlier. It might happen a little bit later. It might not be till 2026. But I think there's going to be some nice buying opportunities. I don't think there's going to be this blood on the streets that some people were hoping and waiting for. And I don't think that's necessary. I think you need to look for properties that are cash flowing, that are good assets, good locations, just make a lot of sense and buy them at a really solid basis. So buy at a low basis, value of 20% or greater under the peak, right? Buy for cash flow today. Needs cash flow tomorrow, today, tomorrow, right? Even if it has 10% rent declines, it needs to cash flow. I think you need to have ample cash reserves because we don't know what's going to happen. And I think if you're in these, Sun Belt markets, you got to really be prepared for continued rent declines. Make sure you have plenty of cash. Just be very cautious if you're in those markets. They're going to be strong markets in the end, but the next 1, 2, 3 years, they're going to have continued problems. And the last thing I just mentioned is lock your debt in for 5 years or longer. It allows for growth to take place. It allows for a flexible plan. In my opinion, the most flexible plan. If you lock it in, yeah, you have a prepayment penalty. But if you lock in with a step down prepayment penalty, you got 5, 4, 3, 2, 1. So what if I've got to pay a 2%, fee on my mortgage to get out of the loan? If the deal works and it makes a lot of sense and I want to sell it in 3 years, go ahead and do that. If you think you're going to potentially keep it for longer, then put in 7 or 10-year debt on it. I think that's great. I think, we're going to see a lot of loan maturities happening. So that's providing opportunity. And I think that it's going to be out there. So be on the lookout and be out there talking with brokers, be out there talking with property owners, be out there talking with investors. Find deals. You're going to have to dig through a lot to find the few that work, but I think with a lot of patience and just continual persistence, consistent persistence, you will find the right deals that work for you. All right, that's it for me. I hope you enjoyed the episode. And if you did, again, share this out. Love more people to be able to hear this and love to be able to hear what you want to hear about. So reach out to me and let me know. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.